Hello and welcome to Blue Collar Wealth Club. I am your host, Jerry Garcia, and today I'm going to do a solo episode where I want to teach you a little bit about a topic that I think is important to most people, but may be important in a slightly different way to business owners. So we're going to talk a little bit about mortgages, how to obtain them, what the different types of mortgages are, and the reason I say that they're slightly differently important to business owners is simply because if you've ever tried to get a mortgage as a business owner, most business owners do the best they can to lower their tax liability. What that does in the mortgage world is that makes it a lot more difficult to get a loan. So I wanted to kind of cover some of the different loan product types and explain what the differences are, and then get into some alternative lending types that can really help you as a business owner into not only building a portfolio of investments for yourself, to cash flow, but also to buy a house for you to live in. I think a lot of people struggle to get a mortgage who own a business, especially if they have a CPA who's really good at lowering their tax liability. So we'll start off by just kind of talking about, your basic mortgage. What is a mortgage company doing? What are they looking for in order to qualify you? So typically, when you reach out to your lender and you're trying to get a mortgage, they're going to take a look at your income and they're going to ask you for your tax returns. This is where business owners get in trouble a lot because on paper, their business may not show a lot of income. If you pay yourself a W-2, we can use that as long as there's a 2-year history. But if you don't, you're looking at strictly your K-1 or your Schedule C on your personal tax return, or maybe an 1120S on a sole prop or an S corp. So we're looking to see what that income is after expenses, because according to the IRS, whatever you're paying taxes on is realistically what you're making. Now there are certain tax write-offs that can be added back in, things like depreciation, things like business use of home, stuff that's not costing you real dollars, but that you get as a tax break, can be added back into your income. So let's say you look at your tax return and your business brought in $250,000 last year. When it's all said and done, after all of the expenses for marketing, for payroll, for employees, when it's all said and done, your business on paper looks like it makes about $25,000 a year. That's where you get into trouble trying to buy a house, because the IRS is going to say, well, this is the money you pay taxes on. So according to us, this is how much you make, and that's what lenders are also going to use. So if you've been playing that tax game really well, it can be very difficult to obtain a mortgage. So the things that we talked about, let's say you have in that $25,000 or in the addition, the extra $225,000 in expenses in our scenario here. Let's say that $15,000 of that is depreciation. Okay, well, because that's a write-off and not an actual cost, that can be added back, and so now your income looks like $40,000. And let's say that you have some like a business use of home, and you're able to claim $10,000 as your business use of home. That can be added back in, and now you're at $50,000 in income, so on and so forth. So different loan types will look at these your bank statements, or your taxes a little bit differently. So your main types of mortgages are going to be FHA, conventional, and VA. Those are the three that most people are familiar with. And we can kind of go over the different of those. Let's start with VA. VA is an excellent product. Only applies to those who are eligible based on their service, either active duty or in some cases even reservists can get that benefit. If you are eligible for VA, you should almost certainly use it. The main benefit to a VA loan is no down payment required, right? So you can finance up to 100% of that property, depending on how much that property costs and depending on how much eligibility you have. We can go into a whole kind of plethora of things on that specifically, but that only applies to those who've served the country in the military. The next two most common are going to be for anybody who's not military. You're looking at FHA and conventional. Now, a lot of people have this thought in their mind that you have to put 20% down to buy a house. That's not true, either for FHA or for conventional. If you're a first-time home buyer, with a conventional loan, you could put as little as 3% down. And if you're not a first-time home buyer, your minimum payment on a primary residence, we're speaking about primary residences in all these cases, your minimum down payment is going to be 5%. On an FHA loan, that minimum payment is 3.5%. Now, if you're looking to buy an investment property, in a lot of cases you will have to put at least 20% down, and a lot of cases the pricing is much better if you put 25% down or more. But right now, let's just stick to talking about buying a house that you plan to live in full time. So, if you're looking at a house that costs $250,000 and you want to put 3% down, well, that's not bad. That's only $7,500. You will have closing costs and a lot of other costs on top of that. So it's not going to be just $7,500 out the door, but there's a lot of negotiating in there with the seller. Maybe you can get some concessions from the seller to help cover some of your closing costs. But the bottom line is 20% is not a requirement. There's another loan type that's used fairly often depending on where you're at in the country, and that's USDA. USDA can also finance up to 100% of the purchase, but it's only in eligible counties or eligible areas, and they're going to be more rural located areas. So to be honest, USDA is not something I've ever dealt with. I live in a city. I did most of my lending in cities across the country, so there are some specifics to be aware of with USDA lending, but it's a great product for those who qualify for it, for those properties that qualify for it. It can be a great benefit. So as we've talked about some of the challenges with buying a business or buying a home as a business owner, we've talked about the income. The other piece is obviously you're going to need some assets. You're going to need some money to put down. You're going to need some closing costs to cover. You have to pay for things like, your credit report, your appraisal report. And where this can get challenging as a business owner is the lender is going to take another step in there looking at your business income, and they're going to look at your business assets. If you're using any assets from your business to put down on that house, they're going to take a deeper dive into your business and make sure that that won't have a negative impact on your business moving forward. And so there's a lot of deep diving that has to be done there, and that can be a challenge sometimes as well. If you're taking a big chunk of money out to put down on a house, they may look at your tax return and decide that maybe it's going to have a negative impact on the business, and they're not going to approve it in that case. So there's a lot of different ways to kind of look at these things or kind of, work within the system and kind of get around them. A lot of it, for some people, they will take 2 years or 3 years and really dig in and start claiming a lot more of their income that they actually make, and maybe not writing off as much. So that way on paper, that business looks like it makes more. And that's great for buying a house, but what does it do? It costs you money, in the long run also, because you're paying more taxes on that. And, the more taxes you're paying, the less money you have for down payment, all that good stuff. So something to keep in mind there. So one of the major things that I wanted to bring up in this episode are a couple of alternative lending products that can allow you as a business owner to get into a business with maybe a little bit more money down, maybe a higher interest rate, but without having to sacrifice paying more taxes to the IRS in order to get these loans. And the first one I'm going to speak on is a product that I really like for business owners, and it's called a bank statement loan. So what's going to happen in these cases is the lender is going to take a look at your business bank statements for the last 12 or 24 months. And if you have your funds intermingled, it's going to be a little more difficult because they're going to have to look at your personal bank statements and take your business income from there. It gets a little more complicated when they're commingled like that. But let's say you have a business bank account and, that's where all of your business transactions go. All of your money is paid into there. All of your expenses are paid out of there. It can be a great resource with these bank statement loans, because how the lender is going to treat this loan is they're going to look at these bank statements for, let's say, 24 months, and they're going to go in and look at all of your deposits, all of your eligible deposits for that month. Eligible deposits are anything that is business related. If you're getting a check, if you're getting a wire, if you're getting somebody's, if you have a Stripe and they're paying by their credit card, all of that counts. Really, ineligible deposits are going to be things like bank transfers from another account, anything that's just not related to the business. So they're going to take all of these deposits and they're going to look at it over that 12 or 24 month period. And they're going to say, okay, you had this many deposits. What we're going to do is we're going to just call it a flat 50% expense ratio. We're going to say we think you can run your business on 50% expenses. So they're going to take all of those deposits, average it out over a monthly number, and then take half of that and say that's what we're going to use as your income. Now that's very powerful. I've done these types of loans, and I had a client in particular who, when we were looking at just his tax returns, we were only able to qualify him with about $2,600 a month in income. And that's not going to get you a house in most places, especially in California where this particular gentleman lived. And so he was just getting left and right turned down because not every lender does these types of loans. These are a specialty product that you're going to want to work with somebody who knows what they're doing. So in this case, he was qualifying with about $2,600 a month, wasn't really, getting a yes from anybody. We were able to connect, and he asked me about what these bank statement loans were. I kind of explained the process, and he said, well, I think that might work, and sent me his bank statements over the last 24 months. And after going through and working through all of these deposits, using that 50% expense ratio, we were able to qualify him with an income at $11,000 a month. Now that's hugely different than $2,600 a month. And that $11,000 was his income. That means that we were able to use $22,000 in bank statement deposits every month. Now to take this a step further, you can actually talk with your CPA, and if you take a look at your expenses over the last couple of years, and let's say your expenses are actually less than 50% of that money that you're bringing in, and they're willing to kind of write a paper to say what that number is, let's say that your expense ratio is really only 30%. Well, now we can use 70% of those deposits toward your income, and that's going to be hugely helpful with trying to qualify to purchase a home. Now, the one caveat to this is because it's an alternative loan product, it's riskier for the lender, so it is going to come with higher percentage interest rates. That's just the way that it is, and it is going to usually require at least 10% down. But once again, if you kind of like the way that you've got your system worked out where you're paying the taxes on the income that you actually feel like you should be paying on, and you want to kind of keep it that way, this could be a great alternative for only 10% down. You're not going with the 20% that you'd have to do on an investment property, and you get to keep and use a lot of that income and keep things exactly the same. And as you can imagine, qualifying for a mortgage on $2,600 a month versus $11,000 a month is such a major difference. Now, typically, the lenders are only going to allow you to use a certain percentage of your income toward your total monthly liabilities. So let's take that $11,000 a month as an example. A really easy way to do the math is typically you can go up to about half of that. So in this case, $5,500 a month is what that borrower has allotted for all of their monthly expenses. So if you have a car payment, you have a couple credit card payments, we're going to use minimum credit card payments, we're going to use loan payment amounts, and then subtract that out, and that's basically what you have left over to pay a mortgage. So that's kind of a great tip in this case. It's a great tool to be able to use these bank statement loans if you own a business, if you have been turned down in the past because you just don't show a lot of income on paper. Definitely reach out. You don't have to have perfect credit. You don't have to have 20% down. You could do it with as little as 10%. Reach out, talk to a lender, ask about a bank statement loan. It's a great tool if you own a business for trying to purchase a primary residence. For most business owners, your most valuable asset is going to be your business. But for the vast majority of the population, their most valuable asset is their house. And so it's a great wealth building tool to own a home. So definitely do what you can to get into that home and reach out and ask about that product. And so there's a couple more products I want to talk about. Another one is going to be very specific, usually to banks or credit unions, and it's called portfolio lending. Portfolio lending, if you want to kind of dig into a little bit of how mortgages work typically, your mortgage lender is going to underwrite your file, right? They're going to look through, make sure your income, make sure your credit's good, make sure everything, that's what you're going through this whole process of sending all this paperwork so that they can make sure that you meet the risk profile to be able to pay back your loan. And as long as they deem that that's true, they're going to fund your loan. You're going to get the keys to your house. And then what that lender is going to do is typically they're going to sell that loan, that mortgage, on the secondary market. Usually they bundle up a bunch of them. They sell them to Fannie Mae, Freddie Mac, or another servicer who's going to actually service that loan. So most mortgage lenders don't actually service the loans themselves, meaning that after you close, you're not making your payment to that person who closed your loan. Eventually, maybe after a month or two, you might be sending your payment to another company who bought that loan, and they may sell that loan multiple times over the course of the time that you are in that mortgage. So what a portfolio lender does is they lend their own funds. Basically, this is why it's going to be banks or credit unions, because they're lending their own money and they're making the money on the back end with the interest that you pay every month. And what that allows them to do, it allows them to be a lot more flexible in their terms and how they underwrite. Most major lenders, mortgage lenders, are lending based on the standards of Fannie Mae and Freddie Mac in order to be able to sell those loans to them down the road. So when you have these portfolio lenders, they're able to set their own terms. They're able to go on a little more case-by-case basis. You may be able to, kind of talk to them. They can look through it. They can ask some more questions about your business and determine whether you're qualified that way. So that could be a great alternative to going with a mortgage lender and going directly to a bank or a credit union, because they're going to have a little more options, a little more flexibility. They can even customize their loan terms a little bit and make things a little more flexible and a little more to the way that works in your particular scenario. And so that's a great alternative as well. And one last loan product I want to talk to you about, it's called Debt Service Coverage Ratio loans, DSCR loans. Now these loans are made for investment properties. So once you have your primary residence in place and you want to start investing into investment properties, whether you want to buy a single family home or a duplex or a quadplex, DSCR loans are great because they don't rely on your personal income to qualify you. So how do they work? Essentially what it does is they're going to take a look at the cash flow of that particular property. They're going to say, okay, if you buy this property and you put down, these are going to usually require 20 or 25% down. Sometimes they'll say 15, but it's really hard to get the numbers to work in most markets. So they're going to take your projected mortgage payment. They're going to say, all right, this is what your rate's going to be. If you buy this house and you put 20% down, here's what your monthly mortgage payment is going to be. They're going to take the appraisal for that property and say, or you can do this on the front end before you get that deep into it, how much can you earn in rent on this property? So if your mortgage is going to be $1,600 per month and the average rent for a property of that type in that market is $1,700 a month, well, there you go. That debt coverage service ratio amount is over 1.0, meaning that the rent will cover the cost of that mortgage. Then you can qualify that way. And some lenders will even allow you to go below that number as long as you meet certain criteria, excellent credit, a bunch of money, in reserves in the bank in case, something comes up, you need to continue making those payments. They're going to have a lot of terms like that. Rates are going to be a lot higher than they are on a primary residence. But it's a great tool if you just, if you own a business, you just don't show a lot of income on paper. As long as that rent is going to cover that mortgage, it's possible to get a mortgage on that property as long as you meet the other criteria. So that's probably going to do it for the majority of this episode. I really just wanted to kind of get into something a little bit different. Another wealth building tool is obviously owning real estate, and most people don't have the kind of basic knowledge of how mortgages work, and even less people know about these alternative loan products that I told you about, and a lot of times we're just getting told no. So if you've ever tried to get a mortgage and you weren't able to, if you have questions, feel free to reach out to us. I'm happy to answer any questions, happy to connect you. I know mortgage lenders all across the country. If you've listened to the podcast, that's my background. I've been doing mortgages for the last 12 years, and I know lenders all across the country who can help you if I can't help you personally. But yeah, go out there, get into some real estate. It's a great wealth building tool and a great way for you to own the home that you live in, and then to use that knowledge to go out there and buy other homes and really start building yourself some passive income. So, till next time, thanks for listening. It's been great.